Hi, this is Chou Zhang. First, let me share my screen. Okay, today I'm going to present my research result on liability-driven investment for pension funds with real assets. This is a joint work with Andrew Clare and Iqbal Wadley at Base Business School, which was Cost Business School. I'm an assistant professor at Hanyang University and in the Department of Actuarial Science. And I'm very glad to give my talk at IFIRS 2021. This is the overview. First, introduction and motivation, and then I will describe three objectives of DB, pension fund, and financial markets. And the MSP, multi-stage stochastic programming formulation, will be briefly explained. Numerical results with simulation and conclusion are presented. When it comes to managing a pension fund, there has been increasing uncertainty on financial markets. This is because of the impact of COVID-19 currently, and also the extremely low interest rate after global financial crisis. And even the Fed's tapering action expected in near future. These can derail pension investors' investment strategies. LDI, liability-driven investment, became popular after the GFC, global financial crisis, with the low interest rate environment, because the pension sponsors want to reduce contributions and to lower the pension liability burden. As growth assets, the real assets are in very interesting, increasing interest. However, to compensate the high joining fee and withdrawal fees, their holding period is usually very long. Here are our three research goals. First, to construct an MSP model with realistic setting, especially considering the liquidity penalty on real assets. And second, to compare three bond portfolio strategies, including aggregate bonds, index tracking, and duration convexity matching and key rate duration matching portfolios. And third, to investigate the effect of the real asset. Here they are real estate, infrastructure, timber, and agriculture. Now I'm going to describe three comprehensive objectives of the DB pension fund. It is closed pension fund. The first, funding ratio, and it must be stabilized. And second, the contribution, the lower the better. And third, the buyout cost, low buyout cost at the end of the planning horizon. The buyout is a contract that a pension sponsor or pension manager, they can sell their pension asset and liability to an insurer, so they can remove the pension asset and liability from their balance sheet. Here, the pension investor and sponsor want to maximize the following objective function. The lambda and the delta are the weighting parameters, and U and D are piecewise linear utility and disutility functions. We also include a downside risk constraint called expected shortfall. There is an expected shortfall target at time t that here we denote it by EST. we referred to the Rockefeller and we received 2002 to construct the linear function. It is linear. To replicate financial markets, we adopt a combined approach of the vector autoregressive model with Nelson-Sigel yield curve parameters. From the data that we feed to the Nelson-Sigel model, we collected the parameters beta 1, beta 2, and beta 3, then combine them with asset returns here, all in the vector Z, to estimate the vector autoregressive model. Left figure here that shows you the yield curves at the steady state from the estimated vector autoregressive model. We use monthly data from July 28 to May 2019. And here we used treasury yield curves, the pension discount curve, S&P 500, Bloomberg and Barclay US aggregate. This is the index tracker bond fund strategy. We will refer this to that strategy. And which EPRA narrate US for the real estate and the global core infrastructure for the infrastructure, the global timber and forestry, and Nasdaq agriculture index. We use that. For the period, as you expected, as you know, the short-term interest rates and asset returns are negatively correlated. Now, currently, that kind of the asset prices is skyrocketing with the low interest rate. The right figure proves that relationship. Given the previous market model, that we need to calculate asset prices and returns. When the constructing a MSP model, the time intervals, so in the scenario 3, are longer than a month. It can be a 1 year, 2 year, or 3 years or longer. Here, the interval is denoted by delta T. So S is the asset price, and the capital R is the gross return for the delta T period. Here, we should also calculate the return on duration convex matching fund and the key rate duration matching fund at time T. Here, the equation 4 and 5 show the return on that two funds. Simply say the duration convexity is a weighting value of 2 zero coupon bonds, which have the M sub S and M sub L as maturity. And return on the key rate duration matching fund consists of the similar, but the K number of different zero coupon bonds. Here, I will explain only some parts of the MSP formulation because of the limited talk time. First, imagine a scenario tree with from the root node till the leaf node, and it contains lots of nodes N. So the MSP, commonly the MSP requires two kinds of constraint. First, the cash balance constraint, and second, asset inventory constraint. In equation 6, the cash balance constraint, all components in the left-hand side are about the cash inflows, and the right-hand side is about cash outflows. C is the contribution, and X sub I n to the cell is the unit number of the asset I to sell. Here the fee is a selling fee. And the P in the right-hand side is the pension benefit paid at node N. Or again, the left-hand side, the V sub I n is the deferred selling amounts of the real asset I at node n. What does that mean? That is this, you can see the equation 10. For example, x sub I n to minus n to the cell. The node n minus means the parent node of node n, which indicates the x indicates the unit number of asset I of which the selling decision is made at each parent node, i.e. n to the minus, but each settlement is made at the current node n, and so on. But when the different settlement timing, we can put the different fee structures. Here, this diagram explains what the deferred liquidity penalty on selling real assets. If the selling decision made at time t and each settlement is made at time t, the selling penalty is 7.5%. But if the settlement is deferred to t plus 2, then the penalty is reduced to 2.5%. And there is no penalty if the settlement is deferred to t plus 3. Here in equation 9, here, this means the scheduled amount of the asset I to be settled at node n. We are in the numerical result. We set up the parameter values for the benchmark case as presented in table 1. First, weighting parameters in the left column. The planning period, the capital T is 10 years. The target contribution level, the C hat is 13% of the initial deficit, and B hat is the target buyout cost is 30% of the expected difference between the total buyout cost and the pension liability value. Here the right column, the current pension liability value is $607 million, and the asset value is 85% of the liability, and there is no scheduled real asset settlement. Okay, yep. From the simulated scenarios, we calculated tracking errors of the 3 bond portfolios. As expected, the key rate duration matching fund shows the lowest tracking error. That's 0.0069. These figures showed average optimal portfolio allocation over the 10-year planning horizon, with the hypothetical liability matching portfolio in the far left and the 3 bond portfolios. Black is T-bill, i.e. can be regarded as a short-term bond. Green is for each bond portfolio, and the blue is for equities. They all show de-risking behavior, which is increasing allocation to hedging instruments. In other words, decreasing allocation to the equities. The allocation with the key duration matching is similar to one with the hypothetical liability matching portfolio, which means the key rate duration matching portfolio will replicate the liability itself. This figure shows the probability of the funding ratio in excess of 0.9. The reason I chose the 0.9 is when I said to you that we used the piecewise linear utility function. So in the middle, the one piece of linear line is bounded from 0.9 till the 1.1. So it's a low bound of the center the center linear line. So like the previous result, the key rate duration matching shows the highest and close to the hypothetical liability one. The table also confirms the optimal investment with the key rate duration is the best in terms of the lowering the buyout cost. The average buyout cost with the key rate duration is about 36% of the initial wealth of the pension fund, and the median value is about 27%. Standard deviation is 0.31. These two panels show the value at risk and expected shortfall respectively. Also, the results with the key rate duration show the lowest values over the planning horizon. Now we have added the real assets. The left is with the aggregate bond portfolio with real assets, and the right is with the key rate duration matching portfolio with real assets. Sorry for the poor resolution. Yeah. So here the red is the real estate, the orange is infrastructure, and yellow is timber, and the pale blue is agriculture. So again, but there is these two. There is no deferred liquidity penalty, but immediate liquidity penalty of the 7.5%. So the real assets show significant portions in the optimal portfolio. Then with the deferred liquidity penalty, both present quite different optimal allocation with real assets. The allocations to real assets are larger and earlier for both cases. Probabilities of the funding ratio can be compared to see the effect of the real assets and also the bond strategies. Imposing the realistic constraint, i.e. the deferred liquidity penalty, the benefit from the optimal real asset strategy with the key rate duration matching fund is better than one with the aggregate bond index fund. We can compare these two, the aggregate bond fund, all real assets plus the liquidity penalty with the T-bills here, the key rate duration matching, the real asset and liquidity penalty. They affect very the difference between these two is the largest than the other pairs of the settings. The downside risk measure concludes the same thing. Okay, conclusion. First, we devised a deferred liquidity penalty structure in the MSP formulation. And second, our results confirm that the key rate duration matching strategy is superior to duration convexity matching and aggregate index strategy. Third, on average, the equity investment declines over the planning horizon, so de-risking occurs. Fourth, real assets have a significant role in the optimal LDI portfolio. Lastly, with the deferred liquidity penalty investments, with deferred liquidity penalty investment in real assets is brought forward on average. To see the reference, please see our SSRN working paper. And if you have any question or comments or suggestion, just please let me know. Thank you.